I've asked Ted Torres, Managing Director of Hospitality, to join us today to give a little view of the world of hospitality, what's going to happen now and in the next coming years, in his opinion, and what we're hearing on the street for the hospitality market, and a little bit of his background. So, Ted, pleasure having you here today.
Thank you, Colby. Greatly appreciated. Greatly appreciate being able to speak to everyone out there and that's looking at this outside of CREDE world. And yeah, it's as having been someone who's been in the hospitality industry for now professionally over 37 years. I grew up as a second generation hotelier, so I've seen, peaks and valleys and lived through a number of cycles, both as an owner, operator, developer, and now, where we're plying our trade more on the consultancy side for our clients on the hospitality side. There are, we as the old saying goes, we live in some very interesting times. And so, I would be delighted to, touch on, a number of areas in those interesting times related to hospitality and what I've seen coming out of a variety of industry conferences, some of those that I've spoken at, et cetera. So, yeah.
Let's back up a quick second. So you talk about being a second generation hotelier. So that means a lot of things to different people. Were you a family that, had one hotel or two hotels, or what? I'm prepping you a little bit here because I know your background. So
yeah, exactly. No, so to dive deeper into the background, so my father was a corporate executive in his formation. He immigrated here from Mexico in the early 1960s, became part of the Holiday Inn chain as a food and beverage director, later as an innkeeper, and eventually elevated to becoming president and CEO of Holiday Inns, where we were stationed in Memphis, Tennessee. And then through that, Holiday Inns eventually bought Harrah's Gaming Corporation in 1979. And he was one of a handful of executives that the board assigned for us to move to Reno when Harrah's was a very small gaming corporation at the time. They only had Harrah's Tahoe, Harrah's Reno, and the massive auto collection that Bill Harrah had accumulated. So we moved around quite a bit, and then finally my dad was stationed at Ramada. Ramada came calling when he had a disagreement with the board for Harrah's. Took the golden parachute, taught me how to play golf, which is one of my passions today. Then we moved to the Phoenix, Scottsdale metro area. Have lived here now over 43 years. And so when I actually got into college is about the time while he was doing his stint here in Ramada, got my degree in finance. And then when I came out of school, went to work in a couple of hospitality management development training programs, really kind of just to round out some of my early career knowledge. I had worked a variety of jobs in high school and in college while at a variety of different hotels. I worked at Harrah's as a snack bar attendant at 15, making a couple $100 a day in tips. I was very popular in 1980, as you could imagine, with all of my friends with that kind of money. All the way through night auditor, assistant night manager, front office manager type positions, and really leverage that as within and rounding that out with both Harrah's and Marriott, who have excellent training programs. So that when I came out on the other side, by that time my father had left Ramada and had become a franchisee. And for those that know today, franchising is a very household name, and we all have a great understanding of what franchising is. But back in the mid 80s, there was not a great dearth of franchising knowledge and understanding, which included myself. So, I was given some advice, to go to learn how to lose money on somebody else's dime. And then by the time you get to work with your father, if the two of you don't kill one another, you're going to have a pretty successful company. So we actually did. We did that for 14 years together. Took one property that we had in San Francisco. And my niche was and is still today deal making. I'm still a deal junkie today. Deal making, financial assessment, financial modeling, understanding operations. Because my dad was a phenomenal operator, so I was able to understand all of the expertise necessary in operations. and we leveraged that into a company of 8 full service hotels, where we were very successful on a coast to coast basis with brands such as Ramada, Hilton, Marriott, Holiday Inns, Hilton Garden Inn, Crown Plaza. So we had some fantastic properties, and strategically or non-strategically, we either sold those through a variety of partnership sales and or just pure outright asset sales. And the last property we did together is when he retired and I went off on my own. So that's kind of that migration of the journey, so to speak, in terms of my knowledge of hospitality, and have leveraged that by having a couple of my own companies, and having assets of my own, developing properties, owning properties, putting management companies together. So it's safe to say that there is I've had a wealth of expertise in all aspects of the hospitality industry, not just here in the United States, but also internationally in the Caribbean, South America, and Eastern Europe.
So if you were to pick a country, a hotel, or a place, what are your top 3 in the world?
Well, could you repeat that for me, please?
Sure. I said if you could pick a hotel or country, like what would be your top 3 properties in the world
that I've worked on? Oh gosh, I would say the Hilton Garden Inn in Nizhny Novgorod, Russia. That was a fascinating build, just because that was in 2006. Just to give everybody a frame of reference. So that's when tensions had thawed significantly, and I had gone to work as a consultant at that time with Hilton and a private equity firm to plant the flag for Hilton properties in Russia, because they really didn't have too much exposure there. So the Hilton name is a worldwide recognized name, and it was really an open arms type of situation in the various cities that we went to in Russia, from the governor, the local ministers, the head of finance. So it was a very interesting situation. But developing internationally, developing in Russia or anywhere internationally, the skill set and the metrics don't change. They are the same everywhere. You just have to learn to understand the lay of the land, and who's friend and who's foe, because there are a lot of pitfalls that can befall a lot of folks. Second type of asset would be the very first hotel that my dad and I built together. Memorable experience, tremendous learning experience for me. We had already renovated a number of hotels together, so I understood renovation very, very well. But ground up construction was a new animal to me, and that's what happened in 2002. And so that was the start of my learning curve for hotel development, and that was the Hilton Garden Inn in Rancho Bernardo in San Diego County, which was a great asset, great partnership, and loved working side by side with my dad, in building a hotel. So truly memorable experience, gave me a great foundation for part of what moves me, motivates me, makes me part of who I am today. And I would say the third one is one of my kind of mainstay sayings. My third one, my most favorite, would be the next one. Let's get to the next job. Let's get to the next challenge, because that's what drives and motivates me on a daily basis, is the next challenge. And because every project is a challenge, and it's really fun trying to put a team together, assemble the team so that we can work through the challenges and come out on the other side with a very successful product or project for either ourselves or our clients.
So it's interesting you list 2 limited service hotels. Any full service? I mean, I know you've done part of historic buildings, full service. Other brands you've worked with. What's the difference between the brands?
Well, yes, and great question. So on the full service side, yes, I've done full service Hilton. I've done full service Crown Plaza with IHG. The differences between the full service, and we're doing some renovations right now on some big full service boxes right now for CREDE, converting a Renaissance to a Marriott for one of our outstanding clients. The big differences are number one, obviously, it's typically the size of the asset, the size of the building. Those are your very first challenges. Typically, it's the quantity of key count. So everything that you're doing is not necessarily, times 100 or times 150. It's times 300 or times 400. So you have to take a lot of those matters into consideration. And then dealing with the brands. The brands are very, I will say that they've always been overreaching. In my history of being in the business, they always try to push the amenity creep. And I think, for what I've learned over the years is that everything with a brand is a negotiation. And that's where we really try to help our clients, is to negotiate with with the brands and negotiate out the items that I've learned over the years, that if it doesn't generate ROI, why do we need to do this just because a brand standard dictates that? Can we provide some type of alternate to that?
Let's touch on that a little bit, especially for newer hoteliers that might be listening. Because you've done work with Four Seasons, Ritz, Biltmore, Hilton, Marriott, IHG, basically some of the top, including Rapids. So it's of those, I'd like to touch on what are the items that you're typically looking to negotiate out? Is it, crown holding? Is it holding mirrors, or what? Maybe give some examples of the easy things to go after for new hoteliers.
Yeah, and that's a great question, because the new hoteliers, they may come from other industries where they've built other assets, but hospitality and building a hotel is a completely different animal. It's one of the most complex type of assets to execute on, because you're not just executing in a vacuum. You're not doing the project just in your own local market. There are external influences, and the brands are some of the biggest external influences. So you have to look at it from the perspective of understanding their brand standards, and over the years I've come to learn very, very well the brand standards for that ultra luxury 5+ star, 6-star type category, like you mentioned with a Raffles 5-star category for Ritz-Carlton. They are very, very persnickety in their standards. They don't like to give a lot. What you can negotiate are terms and conditions in the franchise agreement, some terms and conditions in the management agreement. So in the franchise agreement, there are certain components that are just non-negotiable, like the base marketing fees, because that's all part of a contribution fund that goes to the brand parent, and that's what they use for brand marketing. So I've always been of the mindset that I don't mind paying the marketing fees as long as the brand generates the revenue stream coming in. Where you can negotiate is on the royalty fees. You can negotiate your area of protection. You can negotiate the length of term. You can negotiate key money. If you want key money, into the project.
I can talk about key money a little bit, and
exactly.
I think it's free money. So maybe, explain the pros and cons of key money.
Key money is an incentive that is used by the major brands. Hilton does it, Marriott does it, Hyatt is very, very strong on that right now. IHG does it as well. So all of the major players, the major big boys do it. But essentially, it's a financial manipulation by the brand. And what I say by manipulation is they have a couple of key components that they can manipulate in order to try and make a deal structure work for their potential franchisee. One of those is key money. The other is royalty fees and length of term of discount on those royalty fees. So typically you either try to go for a greater discount on royalty fees if you don't need that upfront cash. Or if you do require that upfront cash, you're not going to be able to negotiate too much on the royalty fees, and you'll pay the full boat. But you get that upfront cash, and that upfront cash does not come in upfront by any stretch of the imagination. It comes in at the completion of the hotel. So typically franchisees can use that. Let's say, Hilton says we're going to give you $1 million check the day you open. Okay, great. You can use that as a backstop, to fund working capital, to fund pre-opening expenses, to recapitalize, a small portion of the capital stack in the project. But then again, you're going to get hit with the full boat on the entire franchise royalty fee. Vice versa, where we found. what we found over the years is that it's, if you don't need the cash, you want the discount on the franchise royalty fees, because it's actually, there's more money that you're saving off of the project, off of the top line. Because for, let's say, every point on on a large scale project of say $10-20 million in revenue, every point is real money as you go through this process. So those are the things that you look to negotiate.
Yeah, I was going to say, have you ever kind of ballpark figured out what if you would, an interest rate on the key money is?
The interest rate
is a way to kind of put it in layman's terms for people. What do you think it costs? What do you think it truly costs to take key money?
I think it truly costs to take key money probably somewhere in the range of 8 to 10%. So it's it's not necessarily inexpensive money. You're not paying an interest rate on it, so to speak, back to the brand. But for every year that you have the franchise, let's say your franchise agreement is 10 years, you get forgiven 1/10 of that key money. 1/20th, obviously, if it's a 20-year agreement. But then again, unless you've negotiated a transfer provision within your franchise agreement, you're going to be held accountable for any unutilized term within your franchise agreement. So let's say you sell the asset at year 5, you have to pay back half of that key money that you got if you didn't negotiate in a transfer provision on the key money.
And are you seeing, what's the trend today? We've talked a lot about franchise and management, but then there's also, in many cases, we find that asset management companies in the middle, especially for hoteliers that aren't comfortable running day-to-day, overseeing day-to-day operations. Maybe talk a little bit about the role of an asset manager, in-house versus third-party.
Yeah, exactly. And I think, and let me add one more to that, also brand management too, because that would be your third option. So, for those hoteliers that have developed properties, that have owned properties or operated properties, the brands are going to dictate within the franchise agreement that you have expertise in running that type of hotel. So let's say you operate a number of select service hotels, and all of a sudden you're trying to get into the game of, say, a big full service very profitable box. They are going to ask for demonstration that you have the skill for that, and if not, they're going to require that you have a third-party management company. Now, on the flip side, if you don't have that type of expertise, the brands do mandate that you do bring in third-party management for that particular aspect of the operation. And then finally, on some of those very upscale type properties that we discussed, like the Raffles, like the Ritz, they fight tooth and nail for themselves to manage those assets, in addition to pulling royalty and franchise fees on those. In my professional career, I've always found that to be a conflict of interest, and I try to assist clients of ours in the negotiation process to bring in third-party qualified management companies that have been approved by the brands in order to be able to manage that, because then you have the system of checks and balances. Without that system of checks and balances, inevitably, and not in every case, but the brands tend to manage in a more heavy-handed basis with more more personnel, more A&G, and that's great on the customer service side, but it's at the expense of profitability too. So the third-party management company typically operates an asset like that much more efficiently than the brand does. And if you have that experience on the self-management side, fantastic. If you're a developer that can operate those assets yourself, terrific. That was the case for myself when I developed 8 Wyndham branded hotels in the teens, 20 teens, where our company, we were very proficient in managing assets. So we would build, develop, and operate those assets ourselves.
And when we talk about management, it's not just, I always say, it's feet and sheets and heads and beds, but that comes a lot through the third party chains and the brands. So we're talking a lot about revenue management. So for folks that aren't in the business, how often are you seeing pricing change and forecast and true revenue, not just HR, but to me, revenue management is day one should be something that a GM or DOS or revenue manager is thinking about.
Oh, absolutely, absolutely. It is a very complex world today in managing the sales and marketing and revenue generation process. It is complex in that you have all the third party channels that you have to try to affiliate with and then manage and then try to negotiate a lower commission structure. Typically, the brands have been involved in that, so you typically fall in line with a brand negotiated agreement for those third-party channels, like an Expedia. Let's use Expedia as an example. They're the 800-pound gorilla in the industry, and Expedia's, if you considered a travel company, they're actually the largest travel company in the world, bigger than any hotel brand that's out there. So when you look at an Expedia, their base commission rate is 22%, the highest in the industry. Now, understand, before the internet exploded and became a channel of service for hoteliers, typically we would pay service providers like what we would call the old GDS systems, which is your old airline systems, Apollo, Sabre, WorldSpan, PARS, the others. Now I'm dating myself because we're talking about the late 80s, early 90s. And so it's when you look at that, the typical commission structure was 10%. That's it. That's all you would pay. So when Expedia came along and they became, the big player and dominant player in the market, the next thing that had to happen was the brands had to band together and try to corral that in. And so, as an example, while we had our Wyndham branded properties, they were able to negotiate that down to 16%. So it's still a very expensive channel of distribution to bring into your property. So if you look at it from, yes, it puts heads in beds or feet in sheets, but it's your most expensive way to get that guest into the building, because when you combine the commission that you pay to an Expedia or a Booking.com, which is also at that same type of 14 to 16% price structure, then you have a situation where you're still paying your royalty fee, your marketing fee, your other affiliated associated brand fees. So when you take all of that into account, it's about 30% of your revenue to bring that guest in the door. Well, guess what? Your profit margin on hotels typically is anywhere between 20 to 32%. So it's almost a break-even proposition when you have to manage those channels. That's why, it's important for general managers and directors of sales to be able to manage the brand-related sources. And that's why we've always had that push on the marketing side. As I've sat on advisory boards for both Wyndham, Hilton, and IHG, is to push for that. The best rate is coming from the brand. Your lowest cost source of a reservation is to have it come through the brand. And that's always been the push.
Or your own vanity site. I mean, I don't
exactly
anymore, but like when I was asset managing hotels, we used to try to push 80% plus of our web traffic through our own vanity site, and just so you could also bypass the 3% IT fee, you could bypass the GDS fee, but and sometimes we were actually able to even negotiate a portion of either our vanity site bookings or stuff from Expedia, so that the revenue didn't actually get accounted for at the brand level, because we were big. As I said, still possible today. Now, I mean, I am dating myself back to GFC time.
Yeah, 100%. Yeah, absolutely. That is the other component of it, because the reason people travel is you're at a destination. Somebody has to stay overnight in your hotel room for some reason. So that's the reason to go out to your local corporations, your local companies. You go with the concentric circles of 1, 3, 5 miles for companies that have travel needs, that have business travelers and or leisure destination travelers. I used to own a hotel that was right next to SeaWorld of San Antonio. So we had very strong affiliations with SeaWorld of San Antonio for packaging and packages and everything that goes along with that. So so just because you have the national brand doesn't mean you abandon the local market. The local market can supplement and supplant a lot of that business and help generate that type of revenue for you. So and that's just those are all components of what a strong management company, whether they be third party or internal to your own, should bring to the table. And those are the kind of components that you interview those management companies for. And that's what we do with our clients today. Is we offer that opportunity for our clients today of interviewing and managing third-party management companies that would be appropriate for their type of hotel asset that has that type of expertise. And then over and beyond that, there is a negotiation factor of negotiating those management agreements, not dissimilar to franchise agreements. So if we back up to what we were talking about on franchise agreements, management agreements, there are negotiable components on that too, because some of the larger management companies like to add on additional services that you automatically have to pay for, like technical services fees, like revenue management fees, like marketing fees, and pre-opening expenses, as opposed to just their standard flat fee of 3% of gross revenue and 10% of the EBITDA lift, at the end of the year on a look-back basis. That's the standard franchise agreement. Additional, all of these additional add-ons are really detrimental to your bottom line. And so we try to help our clients really understand what it is that management company may bring to the table to charge that. And we request that be on an a la carte basis, that if the client needs a service, we take that service. If they need, a pre-opening, or if they need a marketing, or if they need a technical service, okay, great. Don't make it mandatory where there's additional fees that are added on.
So you and I can probably geek out on asset management operations for hours.
Indeed.
We're known as a construction, project management owner's rep company, and most people think that just means sticks and bricks, not managing, feet sheets. So maybe tell us a little bit about what you're seeing on the true execution project management, a little bit on PIPs, which our team right now is managing well over, I think, close to 24, plus, office to hotel conversion, plus ground up. So maybe give a little trend on what you're seeing in the market and on the actual project management and ground up renovation stuff.
Yeah, absolutely. I think that's
but you more on the office conversion, just because everyone thinks it's possible everywhere. So maybe give a little insight on what you've learned through the projects we've done.
Yeah, why don't we start with that, because that seems to be kind of the flavor of the day in a lot of the trades and a lot of the talk that we hear about is that's the next flavor, is converting offices, because there's we haven't had that mandate of going back to office space and office. There's great office vacancies nowadays, so owners of office buildings are trying to figure out, well, what do I do? Do I keep it an office building, or do I try to convert it? Well, it is. I will say this: converting an office building to a use like a hotel or multifamily, which we're at CREDE, we're doing both. So there are inherent challenges. Number one is that I read a very detailed analysis in the domestic United States of all of the office buildings, and this is taking 100% of the pie. All office buildings, only about 18% from a brick and mortar perspective could actually even be considered to qualify for one of these two types of conversions. Out of that, realistically, less than half of those could conceivably be done because of the type of construction that those buildings had. So when we look, and what I mean by that is the most common type of construction that could work for an office conversion to another type of asset class is a moment frame concrete and steel structure, where you have big open columns, big open floor plates. You have basically an erector set of a building that if you clean out that floor plate and keep your central core, then you can start off with a clean slate all over again. If you have if you have a lot of,
without naming our client, similar to what you're currently going through and the team is in Hawaii right now.
Absolutely, yes. We're doing a project in Waikiki right now, and actually we have a very unique circumstance in there, a unique twist, and that's the beauty of asset management and project construction management. We have a unique twist on this, is that we've been working on the project a little over a year and a half right now, and this particular building is 10 stories, built in the mid 60s. was originally occupied by the FAA, and the client is having this held as a legacy asset. So they want to convert the use into a hotel use, which we have fully designed. And now, as part of our application process through the various city and state agencies in Hawaii, we have actually found that we have a net negative of FAR. We actually have a lot more FAR available to us than we thought we were originally did. We thought we were over, and so we're going to have to back off on that. But now the investigation has found that we actually can develop another 70,000 square feet if need be. So we're actually performing a complete analysis on the current superstructure of the building to determine how many additional floors we could build. And the client is very, very keen to digging into this to ascertain what could be done there, because that allows many more significant options for the asset, keeping that same basis of the original building, but then adding on and building new on top of that. Now, granted, a myriad number of challenges that we have to run through to do this.
It's great. We did that back in the early 2000s on a project in New York, and we took a 15-story building and basically built an exoskeleton completely around it, and drove piles on the outside and got agreements with all the neighbors in the cities to put Deadman in, and then came up and put a building on top of the existing building.
Mm-hmm.
Just completely were able to almost ignore other than the shear and the lateral load on a subterranean basis. So it's doable, but it's scary in today's construction costs.
It's doable. It is scary with today's construction costs, but it is a consideration, because what that affords is an opportunity where, yes, you can add more keys to the hotel. And if we kept the same type of hotel, I can't identify because of confidentiality the type of hotel it's going to be. But if we were to keep that same type of brand, it would only yield another 91 units based upon the analysis we've performed, in addition to 162 units that are in the building right now, or what we're planning to put into the building right now. But those are oversized suites. So if we actually went to on the upper floors, a more traditional type of hotel, we could get a yield of up to 130 to 140 keys in a conventional, say, boutique, upscale type of hotel that's maybe missing in the market, where there's significant lift because you have a significantly higher ADR. Occupancies in the market run exceedingly high. So all of those are considerations that we're being asked to manage for our clients, and running through with the design team, with the architects, with the structural engineers. We're adding in civil to this, the mechanical engineers, everybody that we're managing in the process. We're tasking this to design. What would that look like from an interior design perspective? So those are all the kinds of components that we help our clients manage. And this is one of those extreme examples where, yes, we are actually doing this right now. But understand, it is a significant challenge.
When you say what's the most complicated? Is it, the curtain wall system? Is it mechanical and electrical, or like what? We all know that it can be challenging. Is it getting light in, or over depth floors, or like what's some of the more technical challenges at this point?
It's actually Colby, the planning part of it. Because it's more of what is the proper battle plan to attack the project, because we have all of the expert consultants on board on the team that are very, very effective and really great at what they do. So it's there's been no insurmountable challenge. It's understanding that given a decision being made, as an example, we're replacing the curtain wall. So because, it's a 60 plus year old building, and we're replacing the curtain wall system on that building. So replacing that curtain wall system, we're now going to have a brand new, modern, new skin on the building. And this was an item that was requested of us by the client to pursue. And we had a cost factor associated with that. It came in at the budgetary number we expected to. So, then the next thing that we ascertained was in the very original design completed by the first architect, was that they were going to have a VTAC air conditioning ventilation system, air conditioning, heating, ventilation system within the building. Well, what that would require is you have to get outside makeup air, into those VTAC units. Well, if we have a sealed curtain wall, how are we going to achieve that? So what we did was we actually looked at, again, because the client stated to us, this is a legacy asset. A legacy asset dictates to us that we do an analysis for, say, 20 years. And over a 20-year time period, how often are we replacing VTAC parts, components, or full-on systems in a highly humid environment? And typically that lifespan is somewhere around 5 years. So you actually have to look at the cost of saying over 20-year time period, okay, you put in a VTAC system, but you're doing it 4 times. So if that's the cost factor of doing it 4 times, over the life period, what's a more efficient system that can work with a sealed curtain wall system? So we had the mechanical engineer run through three different types of systems. Again, VTAC. Then we had VRF, variable refrigerant flow, and then we had chilled water. So we ran through all of the systems. Chilled water is the most efficient. However, it's the most on the upfront cost factor side. But when we actually went through the process of actually the exercise of costing the components out, there was only an excess of a couple $1 million on the chilled water system, but it was much more energy efficient. Also, we weren't filling up landfills with, all of these materials, heavy metals, whatnot. So we were trying to be, very environmentally conscious with that. And the client deemed that to be, yes, let's go ahead and push forward with that system. But that brings it to a modern building.
As you're saying, you're going to get 20 years out of a chiller, and you can replace fan coil units along the way when you're building them. So
absolutely. So it's not that there are insurmountable challenges. It's that we're assessing systems for the optimal efficiency of what may work for the building. No different than what we did with the elevator systems. Because elevator systems, you have to look at the conveying systems, the vertical conveying systems. We assessed that entire situation and help the client understand the process as to who is the best for what reason. And we landed on that as we had gone out in an RFP to 4 different elevator companies, performed the bid leveling, interviewed all of them. With our local boots on the ground personnel, which is one of the very strong points that we have, is our execution team is phenomenal, and they have a lot of expertise to be able to assess these components and know the folks in a given area. So we digress by just speaking about this one project, but I've also done a conversion of an apartment building into a hotel as well. That was a historical project. So again, myriad number of challenges there. That was because we went for historical tax credits, and this was in downtown Los Angeles. Historically, they take a significant amount of time to get completed, and it did 2 years worth of time. But again, it was all of that advanced planning. I can't stress enough, you cannot short shrift the advanced planning on these types of conversions in order for the execution side to be effective, because it will cost you a lot more money during the actual execution versus the upfront planning phase to do this correctly. And then let's talk about the renovations and then ground up. Well, ground up hotels have slowed down significantly, and they've slowed down significantly because of the components of both. We're in a high interest rate environment. Your typical national banks aren't lending for hospitality right now. Debt funds are prevalent. And debt funds are very, very pricey and expensive. Certain deals are getting done when we've seen
pays come in as well.
Yes, exactly. I was getting to that. If you can layer on different components of the capital stack, there are 37 states that are what are called CPACE eligible, or clean property assisted clean energy, and that is a type of financing. That is, in today's world, compared to debt funds where they're charging anywhere between 12 to 14% interest, CPACE is coming in at about 8 to 8.25%. And we know the major CPACE lenders and make recommendations to our clients, particularly for the execution side on CPACE. Another great aspect that has come back within about the past 9 months to a year is EB5. EB5 has come back very, very strongly, but EB5 has to qualify, within that GIS mapping system that the federal government puts out in terms of being able to have job creation, because that's what EB5 is all about. If you create jobs, typically what that happens is you're not in a central business district. You're in some type of outlying area where you're creating jobs for that EB5. Examples of that would be virtually the entire island of Kauai, virtually the entire island of the Big Island of Hawaii. All of those are almost fully qualifiable for EB5. And then when you layer either one of those on along with your senior debt, you still have to come up with anywhere between 25 to 30% equity into a project. And projects are still getting executed if everybody can blend their interest rate down below double digits. Those that meander above double digits, then you're only paying the lenders and there's no return to either your partners, your investors, or yourself. So it's going to be a waiting game based on the capital markets and with what the Fed said yesterday. The Fed indicated they're not going to make an interest rate change now, but the projection still is by the end of the year there may be a reduction because the EU has already started that trend with making their initial reduction. So inflation is technically falling. So we'll see what happens here as we get closer to the election and year end, and what that means for interest rates moving forward. Because right now the high volume of new construction is slowing. Which leads us then to renovations, PIP renovations, and just standard ongoing renovations. Because of COVID, which was a unique circumstance, that none of us have seen in our lifetimes, or frankly, in the lifetime of the traditional modern hospitality industry. We'd never seen a situation where worldwide occupancies were below double digits. You never saw that. So hoteliers were suffering for a number of years, and finally they came out of that. And the brands gave deferrals on renovations. Banks gave deferrals on interest payments. They extended loans and whatnot. So now we're in a situation where the brands have essentially removed all of the handcuffs that they placed on themselves in terms of the request for renovations and those standard 7 and 14 year PIP renovations, which are required by, if you have a franchise agreement, within that franchise agreement, it dictates that at year 7 and year 14, you have to renovate the hotel. You can do a soft goods renovation in year 7, but at year 14, it's a full-on renovation of everything to the then current brand standard. And so what's occurred there is you have hotel owners that may not have the capital to do it because they haven't been able to fund their CapEx reserve due to what happened during COVID. And then you have high cost of goods. So what, in say 2019, 2020, call it your typical Hilton renovation may cost, 7-year renovation may cost $30,000 a key. Okay. Today that's $50,000 a key. And it's because of the higher cost of materials, higher cost of labor, the brand requirements now that on single-bedded, king-bedded rooms, you have to convert your rooms from the old tub shower combo to a full-on regular standardized shower, and that really moves the cost factor up, depending on the type of asset, anywhere between $6,000 to $10,000 a room, just on that requirement alone. So that's really pushed up what the cost factors are. So you have brands asking for these renovations, dictating that they need to be done. At one of the more recent hotel conferences I was at, I'd heard word that between the 3 big majors, there were over 7,000 unfulfilled, uncompleted PIPs. That's a lot of hotels. And that's a lot of hotels that are not 7 years behind because of COVID. They're probably 10 years behind in terms of doing their renovation, which is, obviously an area of opportunity for us, and where we can apply some of that expertise to assist our clients by trying to help them with sourcing PIP renovation funds, which we have some resources for PIP renovation funds through both private money and lending sources. Granted, they're not inexpensive, but they do get the job done. And that can't be all things for all people because it depends on what the senior loan is that particular property may have on it as to whether it will allow that secondary piece of financing on it. But it will get the renovation done. There will be value to that. But more of what we're going to be seeing is, and we actually get transactional activity here at CREDE that provides information to us on both refinances and transactional. Last month, the month of May, were the highest number of hotel transactions in the last 18 months. There were some 60 hotels that traded in the month of May all across the United States. And that's what's going to cause those renovations to occur.
Because I would echo that too and say, where we can also be helpful. The program you helped set up is our national buying power and our national accounts, where we can utilize small contractors that allow owners to get national pricing volume, which is the name of the game. And
absolutely,
we've watched, in my opinion, prices, ADR, average daily rate, really go up to cover the increased cost, to cover the increased cost of insurance, employment, etc. And you're seeing a bunch of older hotels where now the satisfaction scores are going down because they're aged. So, for the clients that have the ability to do it, I would say lean into your big renovations. We think construction costs are going to be kind of at the bottom between now and the end of the year, and start to climb again as transaction volume increases over 25 and 26. But if you could be the best looking hotel on the block, well, now you're going to get that repeat business, and it's a lot easier and cheaper to get that business than it is to try to find a new client.
Oh, 100%. If you're the tip of the spear and you're the first one coming out, you're going to be the call it the newest, freshest or refreshed property probably for 2 years, while the others play catch up. And the opportunity is very strong because due to the fact that there's not a significant volume of new construction, new build hotels that are occurring in any given markets, you're going to be able to take advantage of that. And quite a few of our clients do. Our clients that are undertaking these renovations, we get involved. We ask the questions and we get involved and we ask them, okay, what is your projected lift post renovation? So we know what the target is, because, I come from a background of being a hotelier. So, I understand what a projected lift may be. And typically they're projecting anywhere between 20 to 35, 40% lift with the work that they're doing. And it makes complete sense because while, yes, overall construction costs since 2019, just like everything else being more expensive, construction costs have risen some 34 to 36%. We are seeing the true cost of the materials starting to float down, but labor still remains the challenge. Therefore, some of the efficiencies that we look to are efficiencies in different types or means or methods of construction, that may not have as strong of a labor component, so to speak, that may be prefabricated, that may be able to come into the job site that could be done on a more effective basis, and therefore decreasing that cost factor overall in a project and holding those costs in line. So we manage those components. Yes, the national buying program, absolutely 100%. We have taken the time to go to furniture manufacturers direct, and at CREDE we have a number of sources that we can lean into. So instead of going through the traditional purchasing or procurement program, what we've been able to derive for our clients is some very significant, 7-figure savings on certain larger projects by going direct to furniture manufacturers that have the ability to provide, all of the materials based upon the specifications provided by design and architecture.
HVAC, especially
everything,
especially ceilings. So, yep. So you and I have been sitting here for almost an hour talking, subliminally about what we do, but just to close the loop for everybody, Ted's team can do everything from upfront due diligence to property condition reports to light oversight for private, debt funds or private equity funds, or what we call our light construction management light division. Truly acting as an outsourced fee development. So, Ted, as we get ready to wrap this up, we talked a lot about why the client, but why CREDE for you? I mean, you had a successful company before you became a partner in CREDE and merged your CREDE vision with ours. Why did you join? And what did you tell up and coming either partners or younger folks that are looking to join us coming out of school, like what's the CREDE way and why? What's it good with you?
Absolutely. So this to help everybody that's listening to this, you and I first chatted about doing this 5 years ago. So I was one of the early adopters or guinea pig, whichever one you want to call it. But I was one of the early adopters.
Pioneer.
And pioneer, yeah, that's a good one. And the reason I did this is because I had a company, I had a couple of partners. We had basically five chiefs, and but I was one of the chiefs, but I was also one of just two Indians doing all the work. And it's there became an untenable situation because myself and one of my other partners, we were working 20 hours a day. 3 projects was the maximum bandwidth we could undertake, and we needed help. We needed support. We weren't getting it from the other partners. You and I spoke, and you talked about the robust back office, the back office support, what CREDE provides in terms of administrative support, accounting support, marketing out to the world, but also the number of professionals that we have on the team that are in other commercial real estate asset classes, because we're not just in hospitality, we're in all commercial real estate asset classes, and that intrigued me. And so we pulled the trigger back in December of 19, which was personally great for me because I only knew hospitality, and there's a good chance that I might not be around if I just stuck to hospitality going through COVID, like so many of my industry colleagues did. So it enabled me by moving into CREDE. It enabled me to learn other industry asset classes, which helped us to expand our portfolio greatly in the Phoenix metro area during COVID, because we've done since COVID started, we've done millions of square feet, hundreds of thousands in industrial, hundreds of thousands in self-storage, thousands of units in multifamily, and it helped me to learn other industries and other asset classes, and really build a very strong team here in the Phoenix metro area. So now as we come out of COVID, that laid kind of foundation as we came out of COVID. Okay, let's replicate all of this for what we're doing with hospitality within the company. Find our project managers that have that hospitality expertise, and let's find the right types of projects for them to ply their trade and execute on, so that we really become a point of differentiation for the client, and maintain our tenets of playing offense, maintaining schedule, being ahead of schedule, being at or below budget in today's world, and fighting every tooth and nail for that dollar for the client. So, joining CREDE, the promise made 5 years ago has been more than fulfilled today, where we as a company have grown to a very strong team, working coast to coast from Hawaii to Florida. We're in Mexico. We're starting to push into the Caribbean, and certain parts of Latin America, with a variety of our team members. And it's exciting times at CREDE because, this growth that we undertook over the course of the past 5 years laid the foundation for what I see as the next phase, the next big push by us, because we were able to set all the systems in place needed for anybody who joins the team, to where we can put them in and it can be a plug and play. We have the back office support systems. We have accounting. We have CRM. We're going into the AI side of things. Very strong marketing, strong social presence, and the brand name recognition is growing stronger on a day-to-day basis. And I, for one, I'm very, very excited, for our team and for the folks that join our team, that have recently joined our team, and for those that are considering joining our team. It is, and it's like anything, you get out of it what you put into it. And if you put a lot of energy and effort into it, you're going to get a lot out of it.
I'd say maybe talk a little bit too, just because you have been one of our folks that have participated with our development team, finding and sourcing deals. So you want to talk a little bit about how it works for you being on the service business, but also being able to invest and source deals that we actually buy and develop for our own account.
Yeah, 100%. I think that's what makes us another one of the components that makes us unique, aside from not being just in one asset class and being in all asset classes, is that the message that I put out to the world is that first and foremost, we're developers. We all come from being a background as developers in whatever asset class we may applied our trade in. And so the great thing about CREDE is that about 20% or so of the entire the entire project load that we have right now are projects where we have invested money. CREDE has invested money, and for any project that CREDE invests in, it allows any member of the team to invest side by side with CREDE on a pari passu basis. Our money is treated the same as the company's money. Because CREDE as a company is a fiduciary, so they have to safeguard the cash, safeguard the money, and if it's I look at it from the perspective of if we vetted it, if we've put it through the processes, and CREDE has invested in this, I want to be side by side with CREDE and invest some of my own capital in it, and see the benefits of the upside as well.
Got it. I appreciate that, and maybe let's wrap up with. If you're coming to look to work for us or you're applying for a job, which I would say is applying for a calling, because I want the folks that want to work for Monday, not looking for Friday. But what's a characteristic or what's the culture that makes a person successful? Or maybe talk a little bit the culture of CREDE and who fits into that culture.
Well, these identifiers that you gave of Monday and Friday, I have no idea what those mean because I work every day. That's just been my nature, all of my life. I think it's number one. You'll be joining a great team. You'll learn a lot. We have a great company culture. That company culture fits hand in glove with my personal feelings of business, and that is you want to work with people that at the end of the day you can go out and have a beer with, and enjoy each other and have a few laughs. And we have fostered a great team environment where we put on a number of social related events, both for our own team members, and we bring our clients involved in it as well. And I think that's part of the fun aspect of what it is that we do. The old adage is, says if you love what you're doing, you never work a day in your life. It's true. I love what I do. And I think for those that love what they do, if you want, greater exposure, to work with a great team that's on a growth path, that has national reach and soon to be even greater international reach, come take a look at us, talk to any or all of us, and we welcome you with open arms.
Well, thank you, Ted. And for those listening, I ask you to subscribe, leave a review, comment. Feel free to reach out to Ted, together or separately if you have any questions or anything piqued in interest that we either need help with or give you some advice on. And I look forward to talking to you all here in the near future. Have a great day, Ted. Thank you.
Terrific. Thank you, Colby. Greatly appreciate it. Bye, everybody.